You know what's crazy? There was a time when buying a Toronto condo almost guaranteed you would make money. You could buy a pre-construction condo, sit on it for a couple of years, and when the keys were ready, you would already have made tens or hundreds of thousands in equity. Or buy a resale condo, rent it out, and you would be positive cash flow from day one. But those days are gone. And today, I'm going to say something that might surprise a lot of people, especially coming from someone who's been investing in real estate since 2006. Never invest in Toronto condos again. And now, before you start typing in the comments, hear me out. I owned condos, I lived in them, I've rented them, dealt with the tenants, but the numbers have completely changed. The way I look at real estate investing in Toronto is very different. And by the end of this video, you will understand exactly why condos no longer make sense for investors, what the numbers actually look like, and what you can invest in to build in long-term wealth. Toronto condos were the go-to investments, resale and pre-construction. It was easy, and for a lot of people, it felt very doable. You could buy a one bedroom in a good area, rent it out, and watch the value climb every year. It was the classic entry point for new real estate investors or someone who is very busy with work and family. The reality now is the numbers don't work anymore from appreciation and cash flow perspective. Let's go through a real life example. Okay, let's take a look at this real life example of downtown condo. So what you can see here, I'll walk you through the my analysis tool that I've built. It's broken up into three sections. One is the capital requirement. So you have acquisition, which is to buy the property. The second part is cash flow, which you can see in the middle. So buy it. What does it look like when you operate it? And then the last part is exit strategy. When you sell it, what happens? So in this case, I picked a downtown condo. Took out the address, but this is a recent sale at 600,000. I put the asking price, but that's what it sold for. And then down here, so for the capital requirement is how much down payment, how much capital is required to buy this condo. So in this case, because it's an investment, you have two land transfer taxes paid to the city and the province. You have an appraisal, legal fees, as well as title insurance. The total purchase costs are just over 20,000, and then you have the down payment, which puts it at 140 as a total requirement to buy 160 to buy the $600,000 condo. Now, with respect to the cash flow, and again, this is current at the time of recording rental data, so it's 2,300 for a one bedroom condo paid by the tenant. And then on the expenses side, the condo fees were $550. You got property taxes at $2,800, which is $233 a month. Then you have the landlord insurance. So this is insurance you're required as a landlord to buy for the property, and then the tenant will get their own content insurance, which is completely different, $600 a year. So that puts the net income before mortgage at $1,466. Now with the mortgage, if you jump down to this section here, you'll see that purchase price 600, down payment is 20%. So that's your 120 plus the 20,000 for the closing cost, which is 140 total. And I used a 5-year fixed 4.5% interest rate for the mortgage, amortized over 30 years. With investments, you have two options. You can go 25 years or 30 years. One thing to look at is to stretch it to 30 years to improve the cash flow. Because if you go to 25, you pay more of the principal, but then the cash flow is more negative than the 30 years. So for example here, the mortgage payment is $2,420 for a $480,000 mortgage, a 4.5% on a 5-year term, 30 years. Now, if I go to 25, if you look at that payment, it goes from $2,420 to $2,656. And you can see that the negative cash flow increases
to call it 1,200 from about 900 and change, 950. So that's a number you can play with. But again, what I'm showing you here is how negative cash flow it is for these condos right now in the city of Toronto. So to summarize, before I get into the exit strategy, you need $140,000. You'd be losing $953 a month if you do a 30-year amortization, and that's just money you're bleeding every month, and that's about 11,000 and change per year. Now, this section, and this is something I tell all my clients, before 2020, after 2020, doesn't really matter. And it's something that I personally follow, is any property you own, when it comes to that investment side, or even if it's your own primary residence, it is good to hold on to it for a minimum of 7 years. And the reason I say 7 years is it allows the homeowner or the investor to get mortgage pay down over those 7 years, and at the same time, appreciation of the property. Now, yes, since 2022, prices have come down, but looking at real estate from a long-term perspective, it does go up. It does go up, it does come down. And, the longer, the better it is for someone to hold on to a property. And this is why my advice has always been hold on to a property for 7 years to see what happens to it with respect to mortgage pay down as well as appreciation. If you look at this number, I use 1%, and I'll explain why I use 1%. My baseline for inflation historically is 2%. So every year, things appreciate 2%, or your dollar devalues by 2%. So when I look at investment, and in this case for the condo, I'm being conservative because of what has happened over the last couple of years since 2022. I'm using 1%, which is still pretty generous, because what I'm saying here is it's 1% above real inflation. So reality is 3%, 2% baseline, plus the 1% appreciation, which we have not seen in the last few years. But nevertheless, I want to show a positive outlook, and I used 1% above the 2% baseline. So over 7 years, if someone buys this today, 600, and then in 7 years, it'll be worth 643, 281, and then the mortgage balance is 417, 349. Now, in this case, what I've done is I just used 4.5% over 7 years. Obviously, you got to renew your mortgage. It might be lower, hopefully not higher. It might be the same. But just for the analysis purposes, I kept it at 4.5% over the 7 years just to see where the mortgage balance would be after that time frame. So in this case, the equity, the value is 643, mortgage balance 417, and then the equity is the difference between the two, which is 200 and just called $226,000. So the third part is the exit strategy. So we have capital acquisition costs, is what does it require to buy the property? Then you have cash flow, what does it take to operate the investment for those years? And then exit strategy is if you want to sell it after 7 years, or maybe hold on to it, and that's a personal decision. So in this case, I use 643 as the selling price, which is taken from here, which is the value after 7 years. Then you have real estate fees, you have legal fees. I subtracted the negative cash flow. So the 953 monthly contribution times 12 months times 7 years is $80,000 out of pocket. Then you got to pay off the mortgage. There is a penalty in here. Obviously, when you break your mortgage, it is very difficult to sell a property, close on it on the same day that the mortgage renewal comes up, which I did not take into account here. I just kept it at 0 just to keep things simple. And that leaves the net proceeds at 267, 686. So selling the condo after 7 years, you'll end up with 267 and change. In this case, you've put in 140,000. So your net profit before capital gains is $127,000 over those 7 years. That might look okay, because you put in 140, you made 127. But what I want to show you is you got to look at the big picture is what does it cost to buy the property? What does it cost to operate it? And then what does it look like from an exit strategy? Now, I've kept this analysis simple because there's a few things that are changing over those 7 years. One is the rental income you can charge. That could increase, that can decrease depending on the market conditions. And again, if it's built after November 15, 2018, it is not under rent control, but prior to that, there's rent control, and the rent increases are dictated by the provincial government on an annual basis. And the other part is maintenance fees and property taxes. Those will increase 100%. That's pretty much guaranteed. And that's not taken into account in this analysis. So that would eat into the final figure of 127,536 because property taxes will go up, maintenance fees will increase, and hopefully rents will increase to offset those increases. But that's difficult to predict based on the level of supply of new completions and existing condos for sale in the marketplace.
From a business perspective, there are 3 factors to evaluate. First is the potential appreciation of that investment. And second, which can be broken up into 2 portions, cash flow, revenue, and expenses. With respect to cash flow, what's the upside of revenue coming in? And in this case, it'd be what is the upside of rental income. And for the second portion is controlling costs, which covers the mortgage payment, condo fees, and property taxes. The difference between these two is your cash flow. The question is, does rental income have the potential to increase expenses? Let's break down each point. First, appreciation. It's no longer there. Since 2021, values have dropped, and it will take a while for condo values to rebound. We have record completions coming to the market, and the last batch is due in 2026. Only when the supply of resale condos and the newly completed condos is absorbed, then values will increase. This might take a couple more years. Second, cash flow. With record supply of new condos completed and developers getting into the purpose-built rentals, there is downward pressure on rents. For expenses, condo fees and property taxes have increased significantly since 2020, wiping out any cash flow. In the past 3 years alone, Toronto property taxes have increased by 23%, and maintenance fees are up around $1 per square foot. Now, with respect to maintenance fees, which creep up every year, you have no control over it because of inflation, management costs, and aging infrastructure. In the first few years of a newly completed condo project, maintenance fees increase exponentially since the reserve fund needs to be funded according to the Provincial Condo Act requirement. You can't control it, you can't negotiate it. And the more amenities a building has, such as 24-hour concierge, pool, party room, you name it, the faster those fees rise. Buyers don't pay more for a condo because the building has a lot of amenities. In fact, high maintenance fees actually decrease the resale value because it scares off buyers. The reality is you're paying more every year for something that's actively working against your return. Now, let's talk about control. When you own a condo, you're not just the owner. You're basically a minority shareholder in a corporation run by a board. You cannot decide when the roof gets replaced. You cannot choose the contractor. You can't delay costs. If the board decides as the building ages, the windows need to be replaced, every owner has to pay tens of thousands in special assessments. You're writing that check whether you like it or not. On the other hand, if you own a freehold investment property such as a house, duplex, or triplex, you choose who does the work, how much you're willing to pay, and when to do that work. Condos limit your creativity and income potential. With condos, you're stuck with what you have. You can't force appreciation, such as adding a basement suite, a garden suite, or renovating the property to increase the rental income. With condos, to a certain extent, your rental income is similar to other units in the building. You're entirely dependent on market demand for units in your building. And that is not a position you want to be in as an investor. Now, I know some people are watching and saying, okay, but condos are easier, less work and hassle. And yes, that is absolutely true. Condos are passive, but that doesn't mean profitable. And if you're watching this because you're trying to build financial freedom and long-term wealth, then you have to start thinking like an investor, not a consumer. So if you're not buying condos anymore, then what are you investing in? Here's what you can focus on instead. And this is where the real opportunities exist in Toronto. Look for properties that give you control and cash flow. That means duplexes, triplexes, and houses that can be converted into multiple units. Let me explain why these make so much more sense nowadays. When you buy a duplex or a triplex, you're buying the land and the structure that you can improve. You're buying flexibility. You can renovate, add a unit, refinance, and scale your portfolio. Yes, it takes more work. Yes, it takes more capital, but you can create real equity and generate positive cash flow, even in a market as expensive as Toronto is. And you control the value. If you improve the property, raise the rents, and add another suite, the bank recognizes that in the appraisal. You can't do that with a condo. Another factor to consider is the lack of supply of land. Ground level investment properties include owning the land. There is no more land to build in Toronto. It's all taken. The only option is to build up and higher density. Owning a condo is owning a box in the sky. Now, with respect to an exit strategy, homes with second suite attract a larger pool of buyers. Families, real estate investors, and first-time buyers who will use that rental income to qualify to buy the house. And last but not least, cash flow. Cash is king. When you're making positive cash flow every month, you dictate when to sell. You're not forced to make a difficult decision when the real estate market is down. I can't emphasize this enough. Positive cash flow gives you options. It gives you freedom. Negative cash flow takes away those options. It traps you. And the beauty of owning one duplex paid off in the city of Toronto, it provides financial freedom towards your retirement. So the question is, do condos have any place in the market? Yes, condos are a good option for the following three groups that I see. First is downsizers. For a couple who live in a house as they approach retirement, they need something much easier to maintain. They don't have to cut the grass. They don't have to shovel the snow. A lot less work. They can lock the keys and go down south for the winter. Condos make sense from that perspective. The second group I see is families who have a child attending university in the city, such as U of T, TMU, and to a certain extent, York University. I mean, why pay rent for 4 years when that family can buy an investment condo? The kid can live there, and then over those 4 years, build some equity and hopefully get some appreciation over that period. The third group I see is lifestyle. For a homeowner who doesn't have a car, works in the city, and goes out in the city, it makes complete sense. It provides a quality of life and a specific lifestyle. So from that perspective, it does make sense for them to live in a condo downtown. Here's my advice. If you're thinking about buying an investment property in Toronto, focus on what you can control. Focus on properties that generate income that are positive cash flow. If you want to learn exactly how to find and evaluate investment opportunities that actually cash flow in Toronto, reach out via the link below. I'd love to chat with you. No obligations, no pressure. Thanks for watching, and I'll see you on the next one.